We know this market is the most expensive in history, driven by the Fed liquidity pumping trillions and trillions of dollars into the market. But we know it's going to change. Why? The Fed has told us. They're going to start bringing back that liquidity, and we will start seeing rising rates. And with that, the market's going to take a hit. It's coming. It is way overdue. But today, we're going to talk about how do you hedge for that next downturn. Let's go. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First time here, we do videos just like this, educational. We do market updates, straight talks, live programs, podcasts, you name it. Make sure you hit that subscribe button, and a little like will help us out as well. So, again, as I said in my intro, market's overbought. We don't have to get into that. I'll show you some charts in a second. But the reality is there are ways to hedge, prepare yourself for that. And I'm talking about market timing. I'm talking about some strategies, and that's what I want to go over today to prepare you for the next downturn. Let's go to the big board. Hedging strategies for the next crash. Now, as I said in my intro, we know where we are at the markets. We know that we're overdue for some type of correction. Is it 10%? Is it 20%? Is it more? I watched a video 2 days ago. He's calling for a 60% correction. When you look at the long-term mean, right, meaning the PE ratio of 15, if we were to go back to a 15, it's a 56% correction, okay? Just to put things in perspective. So when it comes, recently I did a video about why the 60-40 model no longer works. I have that right here. I talk about that, about being more tactical in your process of just buy and hold. And one of the things I didn't talk about in that video is if we were, and when we do have a downturn, as I have in the past, I will put in some hedging strategies. The first option is futures contracts. What is that? Let's think about one of my favorite movies, Trading Places, right? Eddie Murphy and Dan Mack were out there, and they're doing the oranges, right? And all of a sudden they change the information based on some stolen documents, and they bet against the market. Okay, which is what they're doing. Because with futures, you think about that right now, which is ironic because the environment we're in as I record this video, an inflation environment, right? In an inflation environment, in order to smooth that out, a lot of airlines and other people will buy futures contracts to smooth out that pricing of their products, right? So futures contract legal agreement to buy or sell, particularly commodity, asset, security, a predetermined price at a specified time in the future, okay? And it's done through the futures exchange. Now, regular investor, probably not. I don't use that. Kind of complicated. You have a lot of specialists. There are some futures ETFs. There are some futures funds out there which are interesting. I don't personally use them, but this is one of the options. Oh, options. There you go. That's our next one. Options, okay? You've probably heard this before. You've got put and call, right? So if you're buying a call option, you're betting into the market's going to go up. Well, if you're buying a put, it's the opposite. You're betting the market's going to go down, okay? And that's something you see, like right now. I get every week on Tuesday, they publish the CFTC options, and I can see what's going on in the market, who's putting money where, okay, in the overall options market. But a put option, it's a contract giving the option buyer the right but not the obligation to sell or sell short a specified amount of an underlying security at a predetermined price, specific time frame, right? That's key. Predetermined price at which the buyer, the put option, can sell the underlying security is called the strike price. Now, actually, you can go to Yahoo Finance and pull these up. Okay, that's what I do when I'm looking at it. You can see all the put in a symbol, an ETF. You'll see the date, the option, the cost for the option, okay? So that's one thing you could do. Again, for me, I'm not really doing that. It's too difficult. Even though by design we're a small firm, I still have over 350 accounts within my practice. It's very difficult to do that across all. Now, I do use a fund of funds ETF strategy that has option strategies built into that. I do have that in our models today. That's easier for me to utilize without having to go through buying and selling options contracts all the time. All right, so next we talk about shorting stocks or ETFs. Think about that movie, The Big Short. Michael Barry, the main character there. He's shorting, at that time, the housing market with all these swaps and derivatives and all this crazy stuff.
Can we make it 100 million?
Paying hundreds of millions of dollars for it. Everyone thought he was literally crazy, and he ended up making like $40 billion, okay? Because he shorted the market. You can short a stock, meaning I'm betting it's going to go down. Same thing as an option, just done a little bit differently. This kind of shows you the process, okay? Short seller borrows a stock from the broker, immediately sells the stock in the market. Short seller buys back the stock from the market. Seller returns the borrowed stock to the broker. Now, before the borrowed shares must be returned, the trader is betting that the price will continue to decline and they can purchase them at a lower cost. The risk of loss in a short sale is theoretically unlimited, okay? And then same goes, and it says if it climbs to affinity of what could happen. So there's a lot of risk associated with this. Again, not something I do at all with my clients. There's firms that this is all they do, although I just read last week a couple of these firms have gone out because this market's gone up. It's been a tough market to short. So another step. The next one is probably the easiest, and this is what I utilize, is inverse ETFs. Inverse, obviously inverse, right? Going up, down, opposite, up. So this is an example, an inverse S&P. You could do a search out there. You've got an inverse ETF for about everything. Gold, treasuries, the NASDAQ, oil, international, emerging markets, China, you name it, right? You can do it. You're not going to have as much juice, return, options, shorting. Potential is much greater, but also is the loss, right, as we discussed. But as an advisor with all these accounts, it's easier for me to put it in and out. You know, this shows an example here when we had the PAL put going back to 2019. If you recall, right before the holidays, they were raising rates at that time. Boy, remember those days? Seems like forever ago. And the market started cratering. We had about a 20% pullback, right? And at the same time, you see this ETF, right? Here's the S&P going down, inversely goes up. Okay, so it's the same thing, right? But again, for me as an advisor, I think that this is easier to use. I do utilize this in my portfolios. I'm going to have done it recently where I shorted the VIX, the volatility index. That's another thing. But I did not short the VIX. I used an inverse ETF. Okay, so to me, this is a better strategy for most individuals. But again, like anything else, you either have a discipline when you're going to sell. Don't get greedy, especially with the volatility index. It can go quickly, take in some profits, be smart there. So hopefully, a couple things here. And again, if you look at our strategy, why I don't believe in 60-40, it's about being tactical, not just buy and hold. And again, the key is it's not what you make, it's what you protect in bad markets. And that's exactly what we talk about as having a process for good and bad markets. Thanks for watching. Michael Loftus, Wealth and Wisdom TV.